Before you ever enter a trade, the most dangerous thing on your screen may not be price. It may be what you believe price is asking you to do. I've blown evaluation accounts, I've overtraded, I've taken trades I had no business taking, and for a long time, I treated every signal like permission to trade. I kept thinking I needed more trades, more signals, more movement, more screen time. But those weren't solutions, they were beliefs. And those beliefs kept producing the same decisions. Different beliefs, completely different decisions. Whenever trading became difficult, I went looking for more information, another indicator, another strategy, another YouTube video saved to watch later, as though the next piece of information would finally fix me. But eventually I realized the problem wasn't always what I knew. The problem was what I believed before I ever clicked the button. Because beliefs create decisions, and decisions create behavior. If we change how we think, we change the decisions we make. And when our decisions change, the way we trade changes with them. So in this video, I want to walk through 4 of the most dangerous myths futures traders believe before they ever enter a trade. Not because I read about them in a book, because I believed every one of them. The market doesn't care how much you know, it responds to what you do. Myth number 1, you have to make the most of your screen time. The first myth sounds responsible, especially when trading isn't your full-time job. You have a limited window, so you tell yourself you need to make the most of it. That was me. I would sit down before work, look at the clock, and immediately feel pressure. I only have an hour. I need to find something. I can't waste today's opportunity. Looking back, that one thought was setting me up to fail before the opening bell even rang. Because when the clock is running, scarcity starts making decisions for you. A setup would be almost there, and I would tell myself that's close enough. Price would move without the confirmation I needed, and I would think maybe it'll work. Then the market would start moving, and the thought would come right on schedule. I don't want to miss today's move. None of those thoughts had anything to do with the quality of the setup. They had everything to do with the amount of time I had left. And once I entered with that mindset, one trade usually became another, then another, and then another. Nobody has 20 good ideas in a morning. I wasn't finding 20 opportunities. I was just clicking. The hard part was that I blamed my schedule. I thought the job was preventing me from trading the way I needed to trade. I thought more time would make me more patient, more selective, more professional. But more time doesn't fix scarcity. It only gives scarcity more room to negotiate. The shift came when I stopped measuring a trading session by how much I did and started measuring it by the quality of the decisions I made. A morning with no trade wasn't wasted. A session where I protected my standards wasn't a failure. Sometimes, the best use of my screen time was refusing to force the market to give me something it wasn't offering. It took me a long time to realize that my job wasn't the obstacle. My scarcity mindset was. The market doesn't reward the trader who takes the most trades. It rewards the trader who waits for the right one. But even after I learned to slow down, there was still something that kept pulling me into trades I shouldn't have taken. Because every time one of my indicators gave me a signal, I treated it like permission to trade. And that sets up the next myth perfectly. Myth number 2, a signal means it's time to trade. I have the receipts. I spent months developing my futures trading model, months testing it, months trying to make the signals clearer, cleaner, and more useful. So when one of those signals appeared on my chart, I felt like I had to respect it. There it is. There's my signal telling me to click. And if I didn't take it, I felt like I was ignoring the very tool I had worked so hard to build. But that was the mistake. The problem wasn't my indicator. The problem was what I expected it to do. I expected a signal to make the entire decision for me. I expected it to tell me that the location was right, the structure was right, the participation was there, and the risk made sense. But a signal can't carry all of that responsibility by itself. A signal is information. An opportunity is information in context. One tells you something happened, the other tells you whether it matters. A moving average can cross, momentum can shift, a candle can break a level, an indicator can print a marker. All of that is information, but none of it automatically means the trade belongs to you. I learned that the expensive way. Signals would appear inside chop, in the middle of a range, against a larger context, or whether real participation behind the move. And I would still take them because I had confused detection with permission. And eventually I changed the model. The newer version doesn't just ask whether a signal occurred, it asks whether the conditions around that signal deserve my attention. Location, structure, context, participation, execution readiness. If those pieces aren't there, the model can recognize the signal and still tell me to stand down. I literally had to program my own tool to protect me from myself because the fix wasn't better signal. The fix was permission rules around the signal. That changed the question I ask when something appears on my chart. I no longer ask, did I get a signal? I ask, is this a signal or is this a setup? Once you stop treating every signal like permission, the market starts moving fast. Which leads me to myth number 3. Price movement means opportunity. The next myth was one of the hardest for me to unlearn because it feels true. Price starts moving fast, candles expand, volume increases, the tape wakes up, and everything in you says this is the opportunity. But movement is not opportunity. Movement is just movement. The market moves all day, but it doesn't make decisions all day. Think about where price spends most of its time. Between decision points, between levels, between zones. That's where price travels. It isn't always where price decides. Opportunity isn't movement. Opportunity is decision. A decision point is where the market has to reveal something. Will buyers defend? Will sellers reject? Will a level hold? Will participation confirm the break? Those are questions the market can answer. The middle of nowhere can't answer much at all. And yet, the middle is exactly where I used to get pulled in. The tape would speed up, price would move 20 or 30 points, and I would think I was watching opportunity appear in real time. So I would chase it, usually in the middle of the range, usually after the clean entry was already gone, usually where normal market noise could take me out before the real decision was ever made. The movement was real, the opportunity wasn't. The realization changed the way I built my model. My signals now require actual participation behind the move. I don't just want price to travel. I want the market to demonstrate commitment at a location where the commitment matters. Because the fast candle in the middle of the range with weak context and no meaningful decision behind it isn't automatically an opportunity. That's not a move, that's bait. So now, when price starts moving, I slow the question down. Is price moving or is price deciding? That distinction keeps me out of more bad trades than another indicator ever could. Don't trade the middle, trade the decision. Whatever happens between decision points doesn't require my participation. And that's where I'll be waiting. But if I could watch charts all day, wouldn't that make me a better trader? That question leads to myth number 4. Myth number 4, more screen time makes better traders. I've never had unlimited screen time. I have a full-time job. I have responsibilities outside the market. And for years, I believed that put me at a disadvantage. I thought the traders who could watch every session, study every move, and stay in front of the charts all day were playing a different game than I was. I felt like a second-class trader. Then I got funded, and I told myself I needed to treat it like a real business. So instead of shutting the computer down when my window ended, I kept watching. I watched the next session, then the next move, then the next signal. The longer I watched, the more convinced I became that I was seeing opportunities. I wasn't. I was watching my discipline wear out in real time. At the beginning of the session, my rules were clear. My standards were clear. My reasons for saying no were clear. But the longer I stayed, the more I started negotiating. The same conversations from myth number 1 came back. That's close enough. Maybe it'll work. I don't want to miss the move. The same mistake from myth number 2 came back. A signal appeared and I treated it like permission. The same trap from myth number 3 came back. Price move and I called it opportunity. Screen time doesn't build discipline. Screen time spends it. Every decision costs something. Every chart you watch asks for attention. Every almost setup asks you to evaluate it. Every move you miss asks you to explain why you weren't in it. Eventually, your eyes are looking at the same chart, but your standards are not the same. The chart hasn't changed, your standards have. Another hour gives you another hour to negotiate, another hour to chase movement, another hour to mistake a signal for a setup, another hour to convince yourself that close enough is good enough. What I once saw as a disadvantage eventually became one of my strongest filters. My limited trading window forces me to decide what matters. It forces me to prepare, it forces me to protect my attention, and it gives my discipline a clear stopping point. I trade less than almost anyone I know, and I've never trusted my decisions more. Not because every decision works, not because I never make mistakes, but because my decisions are made inside a structure I can actually maintain. My screen time doesn't automatically create more skill. Sometimes it just creates more exposure to your weakest habits. So stop apologizing for your window. Structure it. Protect it. Let it protect you. Looking back, none of the biggest mistakes I made happened because I couldn't read a chart. They happened because of what I believed before I ever entered the trade. I believed limited time meant I had to do more, so I forced trades. I believed every signal deserved action, so I surrendered my judgment to an indicator. I believed movement meant opportunity, so I chased price between the places that mattered. I believed more screen time would make me better, so I stayed long enough to watch my standards deteriorate. 4 myths, all of them promise more. More trades, more signals, more movement, more time. But professional trading isn't built on more. It's built on better. Better beliefs, better filters, better boundaries, better decisions. Trading isn't about making more decisions, it's about making better ones. And the better decisions begin before the trade ever does. But here's what surprised me the most. The beliefs that hurt me before I entered a trade weren't nearly as expensive as the beliefs I carried after I was already in one. The belief that I needed to give a losing trade more room. The belief that taking profit meant I was weak. The belief that the market owed me a recovery. The belief that one more decision could fix the last one. That's where we're going next. If today's conversations challenge the way you think about trading, I think you'll want to stay with me for the next one, because that's where we'll tackle the myths that don't just get traders into bad trades, they keep them there. Trade less, execute better.